In every major financial cycle, there comes a stage when steady, predictable growth suddenly turns explosive. It's the moment where markets move from a slow climb to an all-out vertical rise. Many analysts call this phase the acceleration zone, but one macro expert describes it as the second phase of the banana zone, the part of the market where patience finally pays off and prices begin to move in powerful, sometimes unpredictable waves. According to him, we're now entering that exact moment again. In past cycles, this part of the trend has created some of the fastest and most dramatic surges in digital asset history. It's the stage where calm turns into chaos, but in a good way, as liquidity expands, investor confidence returns, and new money floods in. Right now, several global indicators suggest we're standing on the edge of that kind of move once again. Many financial strategists believe the conditions for another explosive uptrend are aligning. Global money supply is rising, central banks are shifting toward easier policies, and overall investor sentiment is turning positive. Together, these ingredients form the perfect setup for another powerful run in digital assets like Bitcoin and Ethereum. From a technical point of view, this isn't the end of the bull cycle. It's the mid-stage correction before the next breakout. Every long-term rally needs pauses like this. They shake out the weak hands and reset the charts before the next surge begins. The recent pullback in crypto and risk assets fits that pattern almost perfectly. The charts show that the market has been consolidating, forming a strong base after earlier gains. When looking back at previous cycles, the same structure appears. A steep rise, followed by a correction, then another, even larger wave upward. Those who misread that pause as the end of the cycle often miss out on the biggest gains that come right after. Interestingly, we've also seen similar behavior in gold, silver, and even traditional equities. Over the past few months, gold and silver have both reached all-time highs. Bitcoin, too, has been testing major resistance levels. None of this is random. These assets often respond together to changes in global liquidity and currency strength. When the dollar weakens, investors tend to shift toward hard assets, things that can't be printed or devalued by governments. And that's what's happening now. Inflation continues to erode purchasing power, the U.S. national debt is at record levels, and central banks around the world are signaling a more accommodative stance. It's no surprise that investors are looking for alternative stores of value. Gold, silver, and Bitcoin are once again becoming the preferred choices for those seeking to protect their wealth. Many long-term investors are taking this opportunity to diversify, using secure, tax-efficient platforms to hold digital assets and precious metals for the long run. It's a move that's gaining momentum, as people realize traditional savings are losing value faster than ever. Now, if we zoom out and look at the broader business cycle, we can see why this moment matters. The business cycle, the natural rhythm of expansion and contraction in the economy, drives earnings, market sentiment, and investment flows. For the past year, global growth has been sluggish, with manufacturing surveys like the ISM showing weakness. But leading indicators suggest that this slowdown may be ending. Global liquidity, which measures how much cash is circulating through markets, tends to lead the economy by several months. Recently, that liquidity has shown signs of turning upward again. The implication is that business activity could start picking up soon. When liquidity expands, asset prices usually follow. Of course, short-term noise still exists. Government shutdowns, policy delays, and occasional dips in data can make things look worse than they are. But those are temporary distortions. When you focus on the long-term liquidity trend, the direction is still higher. And that's what really matters for assets like Bitcoin, tech stocks, and gold. Liquidity is like oxygen for markets. When there's plenty of it, prices rise. When it gets pulled back, things slow down. Right now, global financial conditions are beginning to ease after months of tightening. Interest rates are stabilizing, commodity prices are softer, and the dollar has stopped strengthening. These are all signs that money is starting to flow more freely again. That flow of capital sets the stage for the next expansion phase, the part of the cycle where risk assets outperform and investors see outsized returns. Historically, these waves don't just lift crypto, they boost small-cap stocks, emerging markets, and high-yield credit as well. When liquidity grows, the appetite for risk increases, and that's when we see the famous everything rally. Gold's behavior gives us another clue. It often acts as a real-time reflection of financial conditions. When gold starts breaking out, it usually means liquidity is improving and investors expect easier policy ahead. Right now, gold's movement suggests that liquidity is about to rise sharply. That's a bullish signal for both metals and digital assets. In the last major cycle, China's central bank played a key role by expanding its balance sheet, injecting liquidity into global markets even as Western economies tightened. That same pattern seems to be repeating now. The People's Bank of China is once again adding liquidity, and its balance sheet trends point to a continued expansion through 2026. Historically, that kind of policy shift has had a huge ripple effect across all asset classes, especially crypto. Interestingly, gold often leads the business cycle by several months. When gold moves higher, it usually signals that the broader economy will follow later. This means that even though we're seeing strong gains in gold now, the full economic upswing may not peak for another year. There's also an important relationship between gold and Bitcoin. Data shows that gold tends to move first, with Bitcoin following roughly 6 months later. This correlation has appeared in every major cycle so far. When gold rallies, Bitcoin eventually catches up, often in a much more dramatic way. This timing is key. If gold is signaling another leg higher, then crypto may be preparing for its own breakout early next year. Historically, after brief cooling phases, Bitcoin has surged again around the April to May window, a time that often marks the beginning of the next major uptrend. Market volatility also supports this idea. Right now, Bitcoin's Bollinger Bands, a measure of how tight or wide price movements are near their lowest levels in history. Every time the bands have compressed this much, a major move has followed. The last 2 times this happened, Bitcoin prices doubled or tripled within 9 months. Seasonal patterns add another layer to the analysis. Historically, the last quarter of the year, especially November and December, tends to produce some of the strongest returns for risk assets. That's because liquidity injections from fiscal activity and year-end market positioning often push prices higher during that period. In many cases, the first part of the year sees markets go flat or correct slightly, only for a massive rally to begin near the end of the year. Bitcoin's historical charts reflect this perfectly. Muted action through September and October, followed by a steep rise in the final 2 months. If this pattern holds, we could see crypto and equities climb sharply as the year ends, peak sometime between January and February, then consolidate before continuing upward again in mid-2025. This doesn't mean the moves will be identical to past cycles, but the rhythm often rhymes. For traders, this phase of the cycle offers both opportunity and risk. It's tempting to get overconfident when prices start rising fast, but it's also important to stay strategic. In times like these, some investors choose to take partial profits during major rallies or hedge with short-term options to protect gains. Others simply hold through volatility, understanding that long-term trends often reward patience. Looking back at 2022, that year marked what many believe was the bottom of the last crypto winter. Since then, the market has slowly rebuilt, setting up the foundation for this multi-year expansion. Early movers who accumulated during that time have already seen strong returns, and according to many macro indicators, the biggest wave of the cycle may still be ahead. The current slowdown isn't a sign of weakness, it's the calm before the next acceleration. Each time liquidity expands, prices follow, and this time the environment looks even more favorable. Inflation is cooling, central banks are shifting toward easing, and investor appetite for risk is returning. If these trends continue, the next phase of the banana zone could bring another extended rally, one that's smoother, longer, and ultimately more powerful than the last. The key, as always, is patience. The cycles may fluctuate, but the broader direction remains upward as long as liquidity keeps expanding. So the question now is, are we still in the early stages of this crypto bull run? And will the next liquidity wave push Bitcoin, Solana, and other digital assets to new all-time highs? Time will tell, but the data strongly suggests we're only part way through this journey. If you've been following this cycle closely, you know how quickly things can change once the liquidity engine turns back on. We may look back a few months from now and realize that this quiet phase was simply the build-up to the next major move, the moment the real acceleration began. For now, staying focused on the bigger picture is what matters most. The macro setup, liquidity trends, and seasonal patterns all point in the same direction. The market isn't done yet. The banana zone may still have a lot more fruit left to bear.